What's going on, guys? Welcome back to another video. We have a very important week ahead for the markets, especially coming off of last week where we saw that 50 basis point rate cut from the Federal Reserve. Now, today we did receive some very interesting comments from some FOMC members, which we're going to be covering. They are hinting at a little bit of a warning side for the market and really mainly towards the overall economy in the near future. And they're pointing to some specific reasons or underlying issues as to why they ended up cutting 50 basis points last week and what we could expect to see going forward. Now, we already talked about the labor market element of this in one of last week's videos. So if you are interested in that one, make sure you guys go check that one out. Because again, there are a lot of reasons why the Fed has done what they've done, but hearing and seeing some more insight into what these FOMC members are actually seeing at this current time is incredibly important. So team, before we get into all of that, if you guys wouldn't mind dropping a like down below if you guys do enjoy these types of videos that I post on this channel here. And again, make sure you guys are subscribed so you guys don't miss another video like this. And again, just very quickly, we are really sitting pretty on some of these Tesla calls that we entered this past week. These are already free. We made them free on this day. Basically, what that means is, again, once they go up a certain percentage, if I sell a little bit of the position, I can take my entire initial investment back and then ride these positions for free. Just basically playing with house money. I'll pop this screenshot up on the screen right here. We did have a really awesome SMCI trade this morning on the stream. Those ran up over 140%. Now remember, those streams are private for everybody in the Discord. Again, you guys get all of the courses, both of them. You get the watch list of stocks that are about to explode, the watch list of cryptos that are about to explode before they do, and FX pairs as well, the pre-market plans, and everything else that we offer in there, guys. Again, that 2-week free trial is coming to an end, so if you guys do want to come in there, see what it's like, and really change your trading and overall market education for the better, because again, I am posting those macro research reports and single stock research reports in there as well. Make sure you guys check out that link down below. Everybody gets 2 weeks free. So first thing that I want to briefly cover over here with you guys is going to be what we have to look for going into this week. So we did see U.S. services PMI and manufacturing PMI this morning. The data was a little bit mixed, but the two main things that we're going to be looking for this week is going to be this GDP revision on Thursday and PCE on Friday. PCE is the Fed's preferred metric of inflation, and as you guys can see right here, the median expectation from market participants is that this number comes in right around 2.3%. Remember, the Fed's long-term target is 2%, so getting down to that area is really what the Federal Reserve is really going to want to see in order to continue moving rates lower. Now, when we think about the bond market here, in the overall expectations of the bond market right now, well, this is going to be the chart of ZB. This is the Treasury bond futures. And when we take a look at the rate cut expectations going into the end of the year, we are still pricing in about 125 basis points total, including last week's 50 basis point cut through the end of the year. The year-end target range for the federal funds rate is about 400 to 425 basis points, or 4 to 4.25%. So we did see a couple of comments today that were suggesting that we were probably going to see 2 more 25 basis point cuts, which is again right now listed as about a 22.5% probability that does occur. But speaking about the bond market here, you guys have all seen the tweets that I've been making about TLT. I know everybody's been very interested in my thoughts on that, because I have been really correct on the bond market for the last basically 2 years here. I did not see any reason why going long bonds into the FOMC meeting was a smart decision. The market had already priced in really an aggressive amount of rate cuts. So in order for bonds to continue even higher, we would need to see the market price in even more cuts. And again, betting on TLT coming to the upside right now isn't just a bet on a soft landing. It's more so a bet on a perfect landing, meaning that you cannot have any of the economic data coming out over the next quarter really point to the direction that things are almost getting worse. Inflation reaccelerating, the unemployment rate coming down, and growth really reaccelerating there, which are all possibilities right now. But I want to go over a lot of these Fed comments that we saw today to really give us an insight into what the Fed is actually seeing right now. Because We did talk about this last week, in that one of the main reasons why the Federal Reserve cut by 50 basis points was because the labor market data that they were seeing wasn't actually accurate. Now, it's not just me saying that, oh, the BLS, the Bureau of Labor Statistics, is lying. No, they came out with an 800 plus thousand job revision to the downside. They were inflating these jobs reports, making the labor market look like it was in a much better place than it actually was. So here are some comments from Goolsby here. Sees, quote, many more rate cuts over the next year. The labor market deterioration typically happens quickly. So here's what he's effectively saying here. The Fed's projection for the unemployment rate right now, like we were talking about when looking at the summary of economic projections from the Federal Reserve, is at about 4.5%. But that can happen very quickly. If you see an exponential growth basically in the unemployment rate, that is going to be a very, very bad sign and will spook the market. That is one of the reasons why the Fed is cutting so aggressively right now. Because again, these labor market deteriorations happen quickly. Jobless rate at a level many consider full employment supported the Fed's half-point rate cut last week. Says the Fed must stay ahead of labor market weakness, which, again, that's kind of what the 50 basis point cut is signaling. And I did write about this in the macro research report that I posted for all of you Discord members this weekend, that the Fed right now is really looking backwards instead of looking forwards. They're trying to solve basically what's happened over the last 6 months, especially with the labor market, to try to get back on track, and then is going to start looking forward to what the incoming data is going to say about the economy in the present. So Goolsby also releases the prepared remarks, which is what these are. Goolsby says rates need to drop significantly, which is very interesting. If a lot of the key economic indicators right now are not necessarily suggesting that we need to drop rates significantly, yes, unemployment is relatively high. Yes, inflation is moving to that 2% target. But again, just last week from the Atlanta Fed, we saw the growth expectation for the third quarter be at about 3%, which is very, very significant. Now, when we move over here, Goolsby, keeping rates at decade high does not make sense when you want things to stay where they are. That is key. And we get a little bit more insight into this when we take a look at some of Neel Kashkari's statements here. Neel Kashkari has been a hawk, meaning that he has been on the side of higher for longer basically this entire year. What they are effectively saying here, before we go into Kashkari's comments, is if they were to leave rates where they are right now, or even have only cut by 25 basis points, remember that tweet from WikiLeaks, I forget which, I think it was Kaplan, an older Fed president, was talking about the potential for regretting not cutting 50 basis points at this past meeting because things could deteriorate very quickly. Now, again, keeping rates at decade high does not make sense when you want things to stay where they are. They want things to stay, again, they want the inflation trajectory to stay exactly where it is, moving down to 2%. They want unemployment basically to not aggressively spike and to stay kind of where it is. Because if unemployment were to drop significantly right now, you could spur growth. You could have GDP starting to move back to the upside, and you could then re-inflate or reignite inflation, which is not what anybody wants to see right now. So they want things to stay where they are. Now, moving over towards Neel Kashkari's statements on why they went for 50 basis points instead of 25, well, I think it's a judgment call. I've been on the more hawkish end of the committee over the last couple of years. Even I say after 50 basis points, I still think the policy is in a net tight position. So what we're looking at right now in terms of the federal funds rate is you have to think about it like almost like a triangle or a peak or a pyramid. On one side, you have policy being net tight, which is going to increase unemployment, decrease growth, and also inflation. Right in the middle is going to be at neutral, which is you're going to have basically what everybody wants in the Federal Reserve right now, keeping things where they are. We will see, again, as we go through this, Neel Kashkari talk about this a little bit more, that neutral rate. The thing is, though, is the neutral rate, we don't know exactly where it is, and it's going to take us a decent amount of time to actually figure that out. And that is what the soft landing is it's getting to that neutral rate without overshooting it too much and without letting things deteriorate too much in the short term, which is exactly what these Fed officials are worried about right now. And why they cut 50 basis points so aggressively, because they don't want these economic conditions to deteriorate. Again, the labor market could deteriorate very quickly. So there's a lot of ambiguity around neutral. Exactly what we're saying here. I write about that in my essay. Other people comment on it. And at some point, we are going to have to debate, are we getting there? I think after 50 basis points, we're still in a net type position. So I was comfortable taking a larger first step. And then as we go forward, I expect on balance, we will probably take smaller steps unless the data changes materially. So we have even one of the biggest hawks at the Federal Reserve supporting this 50 basis point cut. So what is the actual warning from the Federal Reserve right now? The warning is that even after 50 basis points of interest rate cuts, we are still in a net tight position. Now, what does this mean? It means that they have a lot more room to go down, and they have not declared victory yet on inflation. Now, could that come in the near future? Could we see PCE start to move down to that 2% area? Yes, we absolutely can. But what you have to remember about the inflation data that we're seeing is that when we move month to month, the prior month is going to get taken out of the equation. So we could have an unusually high month over month change in CPI 1 month last year, or or a kind of I don't want to say unreasonably, but an outlier, that's a better term for it, an outlier of CPI dropping month over month. So when those pieces of data get taken out of the equation, it's obviously going to change that year over year number. But as we see consistency in that 2% or getting down to that 2%, which right now we are, which is one of the reasons why the Fed cut by 50 basis points, that is going to really give us that understanding of when we're getting to neutral. That is going to be one of the new narratives that we have to pay attention to, and one of the main reasons, again, why it did not make sense to go long bonds. We pushed it a little bit too far with the expectations. Well, I don't want to say we, the overall market pushed it a little bit too far with these expectations, and now they have to come back and figure out where that neutral rate is actually going to be, and that's where the bets are going to be placed. Now, knowing the bond market, it's pretty obvious that they're going to kind of overshoot that, and that's going to be a good time for us to start trading bonds again. But that is effectively what we're looking at here. The Federal Reserve is seeing the potential for economic conditions to significantly deteriorate, which is why all of them except for one, there was one dissent, is in support of this 50 basis point of cutting. Now, the interesting thing about this, and the last thing that I'll leave you guys with, is remember how last week we were talking about how 50 basis points of cutting is a signal that the market, or the economy, let's say, could be in a much worse place than everybody else is really thinking at that time. And if the Fed were to have done that, which they did, it's a signal to the market that economic conditions aren't necessarily good. But what did we see? Well, we saw the market starting to price in 50 basis points. The market ran to all-time highs. The Fed cuts by 50 basis points, and Jerome Powell says that economic conditions are still strong. So the easiest takeaway from this is it's not that economic conditions are really all that bad. It's the risk that leaving rates at those elevated levels is going to then create those economic conditions that are not good for the overall economy. Really high unemployment, inflation no longer moving to the downside there. We see growth moving all over the place. So that is effectively the warning that the Fed is giving. We need to be able to get to that neutral rate. We have to find out what that neutral rate is, and the data needs to come out and support that over the next couple of months here. So guys, that's going to wrap up this video here. If you did enjoy the information and analysis I provided for you guys, make sure you guys go down, hit that like button. Costs you nothing to do. It helps me out a whole lot getting these videos out to some more people. And make sure you guys subscribe if you guys do want to see more videos like this. So I'll see you guys in the next one. Peace.